In this video, we're going to learn what an impairment is and get a general overview of the accounting treatment. First, an impairment occurs when an asset's total future cash generating ability falls below its carrying value. To illustrate, suppose you own a commercial building with office space that you rent. The local economy is in a downturn because a major manufacturer closed its factory. To avoid vacancies, you must decrease the rent charged to tenants. The decreased rental income causes future cash flows related to the building to decline. Therefore, the economic value of the building is impaired. When a long-term operating asset's future economic value is impaired, the firm first recognizes the decline in value as a loss on the income statement in the period that it is determined to have occurred. Second, the firm reduces the asset's carrying value on the balance sheet because its economic value has declined. The impairment loss is a non-cash expense, so there's no impact on the statement of cash flows. The conceptual framework connection shows the why we treat the impairment the way we do. So there's several concepts that are related to the accounting for impairments. The most important is relevance. Asset values should be relevant. An asset involves probable future economic benefits, so a firm should measure these benefits using a relevant amount. If the expected economic benefits are less than the asset's carrying value, reported on the balance sheet, the firm should reduce the asset's carrying value. Measuring an impaired asset at a value other than historical cost involves a trade-off between relevance and faithful representation. So when an asset is impaired, the firm must determine a new carrying value amount based on its expectation of future economic benefits. The estimate of expected future benefits can be very subjective, meaning that an asset balance may not faithfully represent the economic position of the firm with a high degree of accuracy. For example, in order to measure future economic benefits, a manager may need to estimate the future cash flows expected over the remainder of an asset's 20-year life. The manager's assessment of cash flows 20 years from now is surely very subjective. Although this is a trade-off between relevance and faithful representation, when in doubt, firms should err on the side of not overstating net income and assets. Thus, companies are required to write down assets with reduced future economic benefit. In other words, relevance wins over representational faithfulness. U.S. GAAP specifies three major categories for the impairment of long-term operating asset. First, property, plant, and equipment with finite life intangible assets. The second category is indefinite life intangible assets, and the third category is goodwill. Within each of these three categories, we're going to look at four different items related to how we treat it, what the accounting treatment looks like. So for each one of them, we're going to look at how we do asset grouping, when we test for an impairment, the impairment test itself, so how to test, and finally the measurement after the impairment, what do we do from this point forward.